Hi friends, Carrie Scroggins from down in Texas with KDS Insurance Services. And I've had some confusion in the last couple of days about insurance that is in your mortgage, okay? There are two types of insurance in your mortgage for some of us. Not all of us, but some of us. For all of us, if you have a loan, you have to carry insurance on your property. Okay? That's pretty standard. We all know that. The bank is going to make sure that you carry property insurance to protect their asset until you pay it off. And then it's your choice whether or not you continue to insure your property or if you want to self-insure it and just cover all the expenses yourself. But in order to get to that point, you have to pay off your loan because the bank will not allow you to not have it insured. If you choose not to insure it, the bank is going to do what's called forced place insurance, where they will go out and buy the insurance and make you pay for it. And generally, it's 3 to 4 times more expensive than you can buy it privately. So that's a requirement whenever there's a loan on your property. But then there is also mortgage insurance. Okay, this is not a death benefit. This is not if you pass away, it's going to pay off your loan. That is not what this is for. Okay, you can buy mortgage insurance or life insurance. So if something happens to you, it will pay off your mortgage. But that's not what this is. Mortgage insurance is what the mortgage company makes you pay for to protect the loan in the event that you default or they foreclose on you. They're going to get paid from an insurance policy they make you buy, and generally speaking, this has to be included in your mortgage when you don't meet the minimum down payment requirements. Okay? Based upon a lot of different factors that are from the Frank-Todd Banking Act, which I absolutely despise. I think it has caused so much strife for the average American. My opinion, however, don't come at me because of my opinion. It is my opinion and I'm entitled to it. You may not agree with it, and that is okay. It is my opinion. But this is to protect the bank's loan in the event that you default on your loan or they foreclose on your property. And it is a requirement for a certain percentage of down payment. So if you don't meet the standard down payment requirement, if you are a new home buyer or if you get a HUD FHA loan, I think there's a couple of other examples where you wouldn't have to come up with the standard down payment on a mortgage. If you do that, this is going to be a requirement. It's going to be included in your principal and your interest and your taxes and your regular property insurance and your mortgage insurance. So there's principal and interest, regular insurance, your taxes, and then your mortgage insurance. So there's 4 things generally that are escrowed or impounded when you have a mortgage payment. There's no getting around this. The only way this ever goes away is when you meet that threshold, when you've paid enough into your mortgage that you have met that original down payment requirement that you didn't make at the time you bought your house. I know it's confusing, and I hate it. I think it is penalizing and preventing the majority of individuals from being able to enjoy and achieve the American dream of owning their own home, especially in situations where there is one household income, because the average price for a home has absolutely gone through the roof. In some of the markets that I never would have expected, Texas being one of them, we are now out of control with the cost of housing. It's well over $300,000. And if you're a single individual, unless you're making more than 6 figures, it's going to be almost impossible for you to buy a standard home. Now there's other options. There's barn dominiums or manufactured homes or a lot of other different alternatives that are now on the market, because in our world we have realized that not everybody fits into that one mold, and there's got to be a way for everybody to have affordable housing. So there's lots of things happening in the marketplace, but this is what this means. Mortgage insurance is what your mortgage company, it's a policy they put in place. You have no control over it. And then they charge you monthly to insure your loan. So if you were to default on your mortgage and they foreclose on your home, not only do they get the home, but they get the insurance policy that you have paid for to insure the loan. To me, that's a racket. And I don't know how it was ever agreed to and passed by our government. I think it is absolutely wrong. My opinion. Hope that helps. I hope that clarifies a few things. Just remember there are differences. Property insurance, life insurance, which would pay off your mortgage in the event something happened to you, and then mortgage insurance pays off the loan. You don't get any benefit from it, but you have to pay for it based upon your down payment at the time you purchased your home. Sounds like a racket to me, don't you agree? Anyways, I hope this helps. This is Carrie, owner of KDS Insurance Services near the Houston area. If I can help in any way, please don't hesitate to reach out to me. If you have questions on your specific policies, on your specific situation, please reach out to your insurance agent and they can help you understand and explain to you exactly what is what in your mortgage payment. God bless and have a wonderful day.